Is there going to be a stock market crash? I don't know. I would have no way of knowing. I have a canary on my shoulder so that if there is and there's any signals, I can pick up on it. But I really don't know, and you don't know. But we have to plan as if there is going to be. And what do I mean by plan? Well, I think the most important thing is we recognize that we're trying to make money, but the overriding has to be, how much do we get to keep? And how much we get to keep if there's a crash is very dependent upon how we own the shares that we own. Are they in a normal brokerage account, whether it be Robinhood or E-Trade or Schwab, or are they in a qualified account? What's a qualified account, Carrie? A qualified account is an account that gets special tax treatment. That might be an IRA, a SEP IRA, a 401k, a solo 401k, all a different variety of a qualified account. And in future videos, I'll go into some detail as to how they differ and what is appropriate for you. But it's my belief, if you're going to do any trading, you need to be doing it within a qualified account. Why? Because if you get short-term or long-term capital gains, you don't suffer tax consequences. You don't pay taxes on the money inside a qualified account until you take it out. And you don't have to take it out until you reach 70 and a half years of age. So let's postpone those taxes so that tax money that might have gone to Uncle Sam actually compounds in our account. So let's get back to the crash. If I own stocks in a non-qualified account and I sell them, I owe Uncle Sam whatever my effective tax rate is if they're short-term capital gains, or 15% if they're long-term capital gains. So if the crash is less than 30%, let's say, and I'm in the 30% tax bracket, does it make sense to me if the crash is 20%, but I have to pay 30% federal and maybe 10% state? No, that makes no sense at all. So if I'm in a non-qualified account, maybe I'm willing to endure the crash, just ride it out. If I'm in a qualified account, now that's a different story. If I sell out and don't incur taxes and it goes down 20% and I buy back into the same stocks but at a lower price, I make an extra 20%. So my point is, you need to have a plan. You need to understand what you got, how you own it, and what your objectives are. I don't want to go into detail on that standing here in front of this camera, so let's go out on my patio. It's a nice day. We'll sit down, we'll discuss the details of this, and we'll decide if there's a crash and if this canary starts to fall off my shoulder, what am I going to do? And how am I going to do it? Okay, let's start by assuming you've got a brokerage account and it's probably not an IRA account, but you can put up to $6,000 into an IRA. So if you and your spouse, that would give you the ability to put in $12,000. This is, again, if you have a business account and you're generating some sort of income, you need to set up that IRA. That's a starting point. If you've got money coming in on a regular basis, and you can get up to the SEP IRA, now you can put as much as 20% of your annual salary into a SEP IRA, and if you get up to $258,000, that 20% works out to be $57,000. The other option is a solo IRA, and that is you are an employee and you put of your own company, and you put both in as a employer of yourself, and then you also put money in as the employee, and you can get up to I believe it's about $60,000. But the advantage to that one is it doesn't have to be 20% of your income. So I'm going to do some videos specifically on these different kind of qualified plans, because I think it's essential. If you're going to be trading on a regular basis, you don't need to be giving 15, 25, or 30% of your profits to the government, you need that money compounding inside of your IRA accounts so that it grows exponentially. And as I said in my video yesterday, you can, if you do it for 30 years at $57,000 a year and you get a 15% return, you're going to have about $28 million there. That makes for a pretty healthy retirement, even 30 years from now. If you can boost that to a 25% annual return, which I think is really quite reasonable, then you're going to have over $250 million when you retire. So that's important. But again, that's the first step. Now, the next step is let's talk about the prospects of if we have a crash. What are you going to do? And I'm going to reflect on it as my accounts. I have both a joint account, which Nita and I jointly own, and then I have her IRA account and I have my IRA account. So I have two different situations. Now, let's say that I determine or I suspect that there is going to be a crash. I'm going to handle those two accounts very differently because, again, the joint account, I have to pay, if I sell what's in there, I have to pay probably around 30% on my gains. So let's just use some numbers. Let's make it easy. Let's say that I had $200,000 in there and $100,000 of it was gains and it was short-term capital gains. That would mean I had $100,000 of gains and it's short term, so I owe the government 30%. So of my $100,000 of gains, I turn around and write a check to the government for 30%. So I'm working for them. Now, in Alabama, I'll probably then have to turn around and write a second check for $10,000 to the state government. So I made $100,000, whoopee, but I had to give up for 400 or 40,000 of it. That's not a whoopee. So in that case, I'll look at that and say, and the stocks that I hold in there are Apple, Amazon, Google, Microsoft, and Ericsson. So if I'm looking at a potential crash and I say, okay, I believe that these stocks could lose 25% of their value. And I go back and I look at, well, what kind of loss was there in the when the pandemic started? Well, Apple went from $327 to $223. That's a 31% loss. If it did that this go round, I'd take the loss. If I sell the product, sell the stock, I come out 1% ahead. It's not worth the risk. Amazon went from 2,184 to 1,629. That's a 25% loss. That's what happened the first of this year. Again, in my unqualified account, no, I'll just write it out. I will not sell those stocks because even if they go down, I lose when I have to pay taxes. Now, in my qualified accounts, again, I have Apple, Amazon, Google, and Tesla. There, if I come to the conclusion that it looks like the banks are pulling in, and there's going to be some bank failures, and there's going to be a lot of foreclosures because people can't pay their mortgages. In my qualified accounts, I'd probably, if I believed it was going to equal or be worse than the crash of March, I'd sell those and move to cash and wait until it dropped 20, 25, 30%, and I'd buy back in, and then I'd make that full gain. I got no bills to pay with the federal government. I'd make the full gain from selling at the high when I think it's going to collapse, if I'm right. If I'm wrong and I sell, and they say, no, we're immune to the crash because we're such solid, rapidly growing companies, and we're part of the future, not a part of the present, then I lose. So it's a risk and reward situation. Then I think the other thing is is the time frame. If you see that as money that you're going to need and you were going to withdraw anyway because you needed it sometime in 2021, that changes the picture. If you were going to do it anyway, then yeah, maybe that would be the reason why you'd want to sell. So I guess my point is you need to think it through and you need to have a plan. If in fact what happens to you is you make no plan and you just react on a day-to-day basis, which I fear you're doing now, you're going to get caught with your pants down and it's going to hurt. Somebody's going to spank you real hard. So just make a plan and go through your mind and say, okay, first of all, as I said, position your money so you have the choice. So you have the choice because you can, let's say you have a, let's say you have a non-qualified account right now and you have some Amazon in it and you've got a 20-30% gain on it. When you open up your IRA account, you can just move that stock over. You don't want to sell it because then, again, you're going to incur the gain. You want to move the stock over into the IRA account. Now you have changed, you don't have a cost basis you need to worry about. In fact, you could go ahead and sell it if you wanted to in the IRA account and not have that capital gains to deal with. I believe that's correct. Again, I've been out of the financial planning business for about 15 years now. And so you want to talk to your accountant. And again, I know a lot of you are going to say, you're saying to yourself, I don't have an accountant. Maybe you should. Maybe you should have a financial advisor. We're going to get into more about what a financial advisor is all about. You may think I've got this investing thing down. I don't need a financial advisor. Well, there's more to it. We haven't talked about college funds yet and the tax advantages of putting money into a 529 program. We've never talked, if you're in real estate, we've never talked about a 1031 exchange. There's a lot of tax loopholes. There's a reason why rich people are rich. And it's because they understand the tax law. And in many cases, they pay for advice. So don't be, penny rich and pound poor. I think that's what my grandmother used to say. Seek advice, even if it costs you $50 to sit down with an accountant for 25 minutes and say, explain this to me, make sure I'm doing this right. Thank you very much. Here's your $50 and goodbye. Get advice. Make sure you're doing it right. And I'm going to try to bring some financial advisors into the tribe who are willing to share information in the hopes that, some of you will find a need and call them up and become a client. So that's part of my commitment to you. I'd like to again, I'll reach out to Jim Cracciola, CEO of my past employer, Ameriprise. We just passed 40,000. Last time I talked to you, Jim, we were at 30, but we're already at 40 again, and we'll be at a million shortly after the first of the year. You need financial advice. You need to take advantage of the loopholes that wealthy people take advantage of. Again, I qualified for the $1,200 check. Nita qualified for the $1,200 check because we know what we're doing and we know how to avoid taxes. Okay, that's my take on the crash. It may or may not happen, but make a plan so that if it does, you're prepared and you know what you're going to do before you do it.